And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the show. Of course, it's Tuesday as we get, this week underway. Of course, next week is spring break, so we'll be off for spring break next week, but then back the week after that, so we'll get y'all up to date. We'll have some special shows running for you next week as well, just to keep you entertained while things are going on. But in regards to the markets today, bit of economic data out, 2 Fed speakers, so it's going to be kind of an interesting morning anyway, at least. Once we get this economic data out, then later after this afternoon, we're going to have some Fed speakers. Of course, all eyes really kind of focused on what they're going to say because the Fed meeting is coming up here shortly. So the big issue, of course, are we going to cut rates this year? And there's a rising consensus now. Well, I shouldn't say consensus because it's not really a consensus, but there's rising commentary now, I should say, that we are not going to see a rate cut this year, right? It may be next year before we see rate cuts because of inflation being a little bit more sticky, employment remaining very strong right now. Look, economic growth has still been okay, which all potentially feeds into keeping prices elevated, which would keep the Fed from cutting rates anytime soon. So, it's going to be interesting to see as we hear these Fed speakers today, and of course, as we start getting closer to the meeting, if this idea of potentially kicking out rate cuts a bit longer becomes much more kind of a mainstream consensus. The market has already kind of come to grips with the fact they're not going to get 7 this year, which was the expectation coming into this year. A big reason for this big rally back in November, December was this expectation of 5 to 7 rate cuts. The market has continued to rally, but at the same time, the market has continued to rally here. The expectation has now fallen in line with the Fed, which was for 3 cuts this year. The question will now be, what about later, right? If we are only going to get 1 or 2 or none is going to be the big question. This morning, Target reporting earnings coming in better than expected. Of course, they were under a lot of pressure previously because of the whole debacle they got themselves into. Have recovered from that. Stocks up about 8% this morning, beat revenue and estimates on that front. So consumers still doing okay, right, at this point. We're not seeing a massive contraction in consumption. The consumer continues to spend money. They continue to tap into credit cards. They continue to tap on buy now, pay laters, whatever it is, but they're continuing to spend. And so the Target's going to be up nicely this morning on that news. But again, this is just this. We saw the same results with Costco, saw the same kind of commentary with Walmart. So, we're seeing the consumer still hanging in there, which is, important because that's 70% of the economy is the consumer. And so there, for a lot of people expecting this big recession, and again, there's been a lot of talk about that. It's like, oh, this is all going to end badly. Maybe at some point, but right now, there's not a lot of evidence of that. So again, that's just kind of, where we're stuck at the moment in terms of this, the economic data continues to come in okay. Durable goods orders have been okay. ISM manufacturing and services, ISM services still in expansion mode. Yes, ISM the manufacturing data has been in contraction territory, but that's been improving. Leading economic indicators are improving even though they're still in contraction mode. So again, we had talked about this before, is that a lot of this data has been negative for so long, just by its very nature of how we measure this data, because we measure it on a year-over-year basis, the data was going to start improving. And that's what we're seeing. When you're taking a look at, manufacturing numbers as an example, that's pretty much a sentiment survey. How many products did you sell last month? I sold 0. How many did you sell this month? I sold 1, right? So it's an improvement. That's how that works. Well, if you're looking at year-over-year data where we measure a lot of this, is they felt this way last year. And so this year, things are just improving on a year-over-year basis because you're measuring very low readings because we've been negative for so long now. You're now seeing that recovery. You're seeing the same thing, leading economic indicators, et cetera. So again, this is one of the challenges that as investors we have to continue to work through, is this improvement of the economic data, even though all the indicators suggest that you should be having a recession. It's a very interesting conundrum. It's all a function of liquidity that's been pumped into the economy, CHIPS Act, Inflation Reduction Act, et cetera, which is keeping the economy afloat here. But it's a challenge for investors. Now let's talk about the markets. Here's what you need to know before the bell this morning. So we have now had, because this is now the beginning of March, November, December, January, February, 4 months. So this is a 4-month advance in the market. This is one of the longest advances, as we talked about yesterday, since 1970. We've had 16 of 18 weeks positive. Now, here's the issue. The magnitude of this advance is roughly 20%. That's one of the largest 4-month advances that you have going back in history. These 4-month advances like this typically tend to occur just before a period where you get a fairly decent correction. So just keeping this in focus is that this is not normal to have an advance this long with this kind of low volatility. And we talked about this some yesterday, but again, we just remain confined to that trend channel. So again, yesterday markets hit the top of that trend channel. We sold off a little bit yesterday. Markets looking to open lower this morning. Again, we just continue to kind of operate with this very limited upside and a very limited downside. We just kind of seem to be stuck here, and markets just kind of gradually climb this stair step higher, which is fine because everybody's participating. It's all great. It's all good. But again, underneath the surface, we're seeing this rotation back into risk assets. I should say more speculative assets. We're seeing a rotation out of companies that were the Magnificent Seven, right? Apple, Google, et cetera, have been under pressure for the last few days. We're now seeing that money rotate into meme stocks. And yes, the meme stocks are now back into the market. So if you take a look at meme stock baskets as an example, they're grossly outperforming the S&P. So this is the most speculative type of investment out there. These are companies that are very speculative in nature. You take a look at what's happening with high yield bonds. So HYG, which is one of the high yield bond funds. And when you take a look at high yield bond funds, they're doing well right now because there's basically no risk in the market. So I'm willing to take on higher risk bonds that are subject to default. I'm willing to take those on. But the skew and also basically the volatility of these indexes and the yield that you're getting paid for these are extremely low. So you're not getting compensated for the risk. But again, this is back to that idea that I'm going to take on speculative investing to try to make an excess rate of return in the markets. Historically, this always turns out very badly. And again, we kind of go back through history and we look at these periods where we have these kind of excessive speculative outcomes in the markets. The last time we saw a very similar type structure to where we saw here, where you had, again, as we talked about technically, a very large deviation from the 200-day moving average. Again, this doesn't happen that often when you get these type of deviations from the 200-day moving average, combined with this real speculative investment attitude, right? So again, meme coins in the cryptocurrency space are back. Dogecoin, Shiba Inu, etc. Those are surging here over the last few days, in particular as everybody's trying to jump back into the crypto race. You have the speculative meme stock baskets, you've got IPOs. These are all types of speculative products that are out there. And again, when you have these periods of time where you have these very sharp advances in the markets, as you're seeing right now, particularly one that's low volatility as we have now, they all typically tend to correct to a bit of a larger degree than normal. So again, just want to be a little careful here with your speculative risk. Kind of keep a watch on your portfolio, rebalance your risk accordingly. Okay, that's what you need to know before the bell this morning. When we come back, we're going to talk a little bit about valuations. Our report is out on the market on the website this morning. We'll talk about that next. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
If you're nearing retirement age, what's the best strategy for you to take Social Security? And what about your spouse? Our first in-person Lunch and Learn of 2024 will look at Savvy Social Security for couples. Wednesday, March 20th at 11 a.m. in the RIA Advisors Classroom. And yes, there'll be food. Which one of you should take Social Security first? Should you both claim benefits? What about survivor benefits? The Savvy Social Security for Couples Lunch and Learn. Think of it as a double date for your money you can't outlive. Register today at realinvestmentadvice.com. Realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning. At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So, again, just talking a little bit about the markets. Again, just, technically, just we are in the middle of a very bullish, very exuberant run in the markets. And then there's nothing wrong with that, right? There's absolutely nothing wrong with that. Don't take anything away from that outside of the fact that that's exactly what it is. It's just a lot of bullish exuberance. Everybody's very excited. It's just, everything's working no matter what. You kind of throw your money in the market and it just goes up. And this is the interesting thing that we always get to. And, it's always interesting because the emails that I get are the best contrarian indicators of the markets. Comments on Facebook, right? Twitter, whatever. Those are the best contrarian indicators. So one thing that we kind of watch internally and manage our portfolio is the sentiment of people that, email us or talk to us or, post on Twitter, respond to our Twitter feed, et cetera. And when you start seeing a lot of commentary like, oh, this market's never going to stop going up. It's just, this is the new thing. Bitcoin's going to 500,000 or whatever the thing is, right? Meme stocks. Maybe that's the case. Right? Maybe that's the case this time. But almost without fail, every time we start seeing these kind of more exuberant bullish commentaries, and particularly when we have clients that were previously very conservative and now they want to get, very long equities, it's like, oh, I don't want to own bonds anymore, just put me all into stocks. Those are typically the best contrarian indicators because that's where that FOMO has now fed into the retail investor. And the retail, as we talked about yesterday, retail investors are the best contrarian indicator, period, for kind of understanding tops and bottoms in markets. Now, that's not a timing tool. You can't look at sentiment and say, okay, today's the day, we need to sell everything and go to cash. That never works out well. But it's a good indication that, when everybody's in the market, there's as Sam Stovall said from S&P once, he says, if everybody's buying, who's left to sell, right? So at some point, you just simply run out of buyers, and then somebody's going to start selling. But this is just kind of where we are. So again, there's nothing wrong with how exuberant this market is. But again, as we just noted in the last segment, these extensions and these deviations from long-term means will get corrected. That's why I just keep bringing it up every day, right? Just keep a watch on this because when you take out that 20-day moving average, that's going to be your first really decent indication that you've got a potentially bigger correction on hand. Now, that doesn't mean the market's crashing. Doesn't mean you sell everything and go to cash. It just means that there's going to be a better opportunity to buy stuff cheaper than currently. And, this is just kind of the things to keep a watch on. Which kind of brings us to today's article that's on the website, because I had talked about over the weekend in the newsletter a little bit about the Buffett indicator and, Warren Buffett's $160 billion cash pile and his problem with allocating that cash is due primarily to valuations. And we discussed valuations in terms of that metric. And we're going to revisit that a little bit this morning. I have some more work on that. But B of A just recently put out a table of valuation metrics on the markets. And virtually all of them, with just the exception of a couple that are kind of really hard to measure, like equity risk premium, they are all trading at 50, 60, 70, 80, 90% above their averages. And it's a very expensive market. No matter how you kind of measure this market right now, it's expensive. So again, valuations, and this is the important thing, their valuations are not meant to be a timing indicator at all. If you're using valuations as any part of your short-term portfolio management process, stop, because they are terrible for that. Valuations tell you nothing about what's going to happen in the markets over the next month or 3 months or year or even a couple of years. Valuations are terrible at that. What valuations are great at is telling you what your returns are going to be over the next 10. So when you start a 10-year period with very low valuations, you're going to have higher returns in the markets, aka following 2008. When you start a 10-year period with very high valuations, you're going to have lower future rates of return. And right now you have very high valuations, so the next 10 years likely going to be much more muted than what we saw previously. Valuation metrics are simply that. They're just a measure of valuation. And here's what's kind of important about this is that valuations are really more of a measure of sentiment than anything else. So when you start talking about valuations, so valuations are high. Well, what that tells you is that investor sentiment is also very high, very bullish. And in fact, if we align so we have a composite index of consumer confidence. So it takes in the Conference Board in the University of Michigan, makes a composite indicator out of it. So it's kind of a broader measure of consumer sentiment. But if you combine consumer sentiment with valuations, they have a decently high correlation. Not surprising. Because again, valuations are simply just a measure of sentiment. I'm willing to overpay for something today because I think it'll be worth more tomorrow. That's all it is. That's all valuations are. It's just how much are you paying for this asset, whatever it is. And this is always the interesting thing that, we talk about, which is that I talk to people all the time, and they're like, I get emails through, like, hey, do you know the best way to value buying a car, or what's the best way to value if I'm buying a house, so how's the best way to value that, right? Everybody's always looking for a way to buy something cheaper when it comes to paying for an asset, right? So like a lifestyle asset, I want the cheapest computer that's the best on the market with the lowest price. I want the best TV at the lowest price. I want, I don't want to overpay for a house. I want to try to buy that at a discount. So we're always trying to negotiate down on the price of the house, but we don't do that when it comes to stocks, right? We just pay whatever. It's going up. It must be going up more, so I'm going to pay more for it. But, as we talked about before, companies like NVIDIA trading at 35 times, 36 times price to sales. It's not sustainable. No matter how fast you think they're growing their earnings and their revenue, it's a great company, and I'm not poo-pooing the company. We own the company. But it's stupidly priced, valuation-wise. We own it because it's going up, and we have to make money for our clients. But we're watching that very closely, and we will sell it at some point. But if you buy something, a car, can you imagine going to a dealership and buying a Toyota Corolla and paying $100,000 for it. And you just wouldn't do it, right? So the car's not worth that. But you do that every day when it comes to stocks. And that's the interesting part of it. But it's all about sentiment, right? Because we're willing to overpay today we're willing to pay 35 times sales for NVIDIA because we believe that in the future it's going to be the stock price is just going to go up. We don't really care about earnings or fundamentals anymore. We just care about whether or not there's liquidity in the market and whether stock prices are going up. As long as stock prices are going up, it's great. Now, that all goes out the window very quickly as soon as you have a 10% correction. Then everybody goes, oh, the stock market's never going to stop going down. But that's the trap we've gotten ourselves into psychologically in the markets. If it's going up, it's going to go up forever. It's going down forever, and there's no in between. We can't just have a normal market cycle and just understand that markets go up and down over time, and that over time markets will rise and generate some rate of return. But this is a huge issue that's been caused by the Fed and government interventions and the media over the last several years. It is what it is. So we have to play the game. We just need to understand it. Okay, let's go back to valuations. So the point about valuations is about forward returns. So Cliff Asness, who runs AQR, it's a big hedge fund if you don't know who Clifford Asness is, but really smart guy. He said 10-year forward average returns fall nearly monotonically at starting Shiller ratios as they increase. So in other words, as valuations increase, rates of return will fall. Also, as starting PEs go up, the worst cases get worse and the best cases get weaker. In today's environment, now this was written a couple of years ago, Shiller PE of 22.2, today it's 32.1. And your long-term plan calls for a 10% nominal, or with today's inflation, about a 7.8% rate of real return. You're basically rooting for the absolute best case in history to play out once again, and rooting for something drastically above the average case from these valuations is a bit optimistic. And so we can kind of prove that by looking at forward returns. So if we look at a correlation of historical valuations versus forward returns and look at where we are currently, your best case scenario is about 5%. Your worst case scenario is a negative rate of return over the next 10 years. Now, 5% you may go, well, that's okay, 5%. Okay, that's not going to feel so good over 10 years when your last 10 years were cranking out almost 12% a year on average. So lower forward returns are going to feel worse, theoretically, if it occurs, only because you're coming off a period of excess rates of return over the last 10 years. Because that's what valuations tell you. Now, when we come back, we'll pick up with Warren Buffett's market cap to GDP and what it tells us about forward returns as well. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
If you're nearing retirement age, what's the best strategy for you to take Social Security? And what about your spouse? Our first in-person Lunch and Learn of 2024 will look at Savvy Social Security for couples. Wednesday, March 20th at 11 a.m. in the RIA Advisors Classroom. And yes, there'll be food. Which one of you should take Social Security first? Should you both claim benefits? What about survivor benefits? The Savvy Social Security for Couples Lunch and Learn. Think of it as a double date for your money you can't outlive. Register today at realinvestmentadvice.com. Realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k 401k plan, just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
I learned a very valuable lesson yesterday, Brent. You know, my wife had a really hard day at work, and she came home, and she was a little bit stressed out. And I said, well, honey, I'll take you to go get a scoop of ice cream. She said, no, I can't. I'm too fat. That's where I made my critical mistake.
The Real Investment Show podcast.
I said, okay.
Same show, your schedule.
Then I realized at that moment that I'd made this crucial mistake, which was I should have said, no, you need to get 2 scoops because you're too skinny.
At realinvestmentadvice.com.
You need some ice cream. Go eat a cheeseburger.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning. At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show. So talk a little bit about valuations and forward returns. Again, stuff you already know, but just it never hurts to kind of reiterate the case and just kind of picking up a little bit on Bank of America's recent analysis talking about, you know, virtually all metrics across the board are very overpriced relative to history. And so you're buying a very expensive market and one also that's very highly concentrated among other issues. But that's just this dynamic that we built in the market, right? It's all about the Fed. It's not about fundamentals or anything else. And so these markets can remain irrational longer than you can remain solvent, as the old saying goes. But I just wanted to come back and touch on a little bit about market cap to GDP because I did a bit more work on that since Saturday when we touched on it in the newsletter. But Bank of America had the market cap to GDP ratio at 95% above its long-term average in its table. It's actually over 100% above it when you adjust for inflation. And on an inflation-adjusted market cap to price, or market cap to GDP ratio using inflation-adjusted GDP, inflation-adjusted market cap, you're trading at about a little over two times, right? 2.04 times market cap to GDP. Now, again, as we talk, if you missed the show yesterday, we talked about this, but basically the economy should not, the market should not trade above the economy. In other words, you should never trade more than above 1% or 1 times market cap to GDP because the economy is what generates the revenues and the earnings for companies, right? The companies just don't manufacture earnings. They have to come from the economy. So you should never trade above 1, and if you do, that's really expensive because that means that people are pricing in more into stocks than what the economy can actually deliver. And historically, when we've had periods above 1, things have not turned out so well, right? Crash of 73, 74, the dot-com crash, financial crisis, and, 2022, we were at 2.61. We're still at 2.04. Now, here's the important part about that. So, again, what does that mean for forward return? So, first of all, if we take a look at a correlation graph of market cap to GDP ratio relative to the real S&P 500 price, we see that we're very deviated right now from kind of a long-term correlation, which runs about 0.72. So it's a high correlation, right, as you would expect. The last time that we were kind of this deviated again was at the very end of 2021, and then we had the 2022 correction. And so we're very deviated from the norm in terms of market cap to GDP ratio. Now, what does that mean for forward returns? Well, if we take a look at market cap to GDP versus forward 10-year real returns, we find out that we're currently looking at about a negative 5%, negative 3 to 5% growth over the next 10 years in returns. And again, not surprising. Very high valuations should lead to lower than expected forward returns. And so again, none of this should be a surprise. But this is why FOMO right now, the fear of missing out, trumps the fundamentals. And in the heat of the moment, just fundamentals don't matter. Investors don't care about fundamentals. You talk about fundamentals, stocks being expensive, like who cares, right? I'm going to buy meme stocks. I'm going to buy companies with absolutely no fundamentals. I mean, at least if you're buying an Apple or a Google or an Nvidia, you're buying companies with strong revenue growth. But they're buying companies that have very little revenue growth, if any, right? Very speculative, negative earnings. But they're just buying them because they're going up. And so that's just the nature of market cycles. You know, it's one of the primary ingredients necessary to create the proper environment for an eventual reversion. You got to have this. You can't have, if you don't have big excesses, you can't have reversions. You can't have discounts. Things have to go up and down. If everybody just paid fair value, the market would be flat. It wouldn't go anywhere, right? So David Einhorn once explained that the bulls explain that traditional valuation metrics no longer apply to certain stocks. The longs are confident that everyone else who holds these stocks understands the dynamic and won't sell either. With holders reluctant to sell, stocks can only go up, seemingly to infinity and beyond. We have seen this before. There was no catalyst that we know of that burst the dot-com bubble in March of 2000. We don't have a particular catalyst in mind here. That said, the top will be the top, and it's hard to predict when they'll happen. Now, that was from David Einhorn back in 2007. James Montier had written fairly the same thing. He said, current arguments as to why this time is different are cloaked in the economics of secular stagnation and standard finance workhorses like equity risk premium models. Whilst these may lend a veneer of respectability to those dangerous words, taking arguments at face value without considering the evidence seems to me at least to be a common link with previous bubbles. And we're doing the same thing again. Every time we get into these situations where markets are just kind of going up every day, and we get a lot of FOMO, we get a lot of greed built into the market, we start coming up with rationalizations as to why it's different this time, right? We always come up with a new reason, and the media is fantastic about this, right? Because they'll come out with like, oh, well, you know, we didn't have AI before, and AI is going to create this whole productivity issue that's going to render, you know, previous earnings metrics irrelevant, you know, whatever, you know, come up, you know, insert your own rationalization, but this is what we do. We come up with reasons why stocks will go higher from here because it's different this time. Stocks have reached a permanently high plateau. But that's what we do as humans, right? As humans, that's what we do. That's our nature. Conversely, when we do eventually get a correction, and we will, and we're down 10% from the market peak, everybody will be rationalizing why markets are going to just keep going lower, why the bear market's back, etc. Right? Same thing happened last year. It'll happen again probably this year. We'll see. But, you know, as B of A noted in its analysis, stocks are far from cheap. Take a look at market cap to GDP. Stocks aren't cheap. Historical expectations of forward returns are low. And that doesn't mean, importantly, that returns are going to be low every year. This is the big differentiator. It doesn't mean that if you just go to cash today, that over the next 10 years, you're going to be okay. It's true, inflation is going to eat you up, but the return structure over the next 10 years is likely not going to be great. But the problem is going to be is that you're going to have a 10% up year this year. I'm just throwing out random numbers. 10% next year, the market will be up. Then you'll be down 20%. Then you'll be up 10% for a couple of years. Then you're going to be down 10%. And when you go back and look at your rate of return over that 10-year period, it'll be close to zero or slightly negative. Doesn't mean it's going to be negative every year. There's going to be years to make money. There's going to be years to avoid risk. This year's a year to make money and to avoid some risk. Because again, we're still going to have a correction at some point this year, probably this summer. So we'll want to avoid some of that risk. But this will be a year to make some money. Next year is a different story. Arthur Levitt, back in 1998, had a speech that he gave. He was the SEC chairman at the time. It's called The Numbers Game. And he stated that while the temptations are great, and remember this is 98, this is going into the bubble. While the temptations are great and the pressure's strong, illusions and numbers are only that, ephemeral and ultimately self-destructive. And this is because we were rationalizing why all of these dot-com companies at the time were going to be the next great thing, even though they didn't have earnings. And we came up with new metrics to justify them, right? Eyeballs per page, clicks per page, all these metrics, monthly average users, right? When Meta still reports, they still report, or these social media companies, what's your monthly average user base? They throw out these numbers. 5 billion monthly average users. A lot of those are bots. Out of 5 billion, 3 billion of them are probably bots, right? But we make up these metrics to justify success that have nothing to do with the underlying fundamentals. But that's what we do as humans, right? There's a straightforward truth. The stock market is not the economy, but the economy is a reflection of the very thing that supports higher asset prices, which are earnings. You're overpaying for earnings across the board. But that's the market we're in at the moment, right? That's the FOMO part. And again, this can last a lot longer than you expect, but the economy is slowing down. The pandemic-related spending is draining from the system, and it's doubtful that the government's going to continue to spend at the clip it was doing before because of where we are with the deficit and the debt, and you're adding $1 trillion a year to the debt. We're having another debt ceiling debate right now, another debt issue, right? We're going to have to avoid a government shutdown, so we're going to have to spend another $1 trillion, even though we just did this back in December to avoid a government shutdown. We're going to do this again because we keep running out of money. There's a limit to that. There's more than a reasonable expectation of disappointment in the future. And it's just something to consider when you consider how much risk you're taking in your portfolio. Just be careful that you're investing, not gambling. Be right back.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
If you're nearing retirement age, what's the best strategy for you to take Social Security? And what about your spouse? Our first in-person Lunch and Learn of 2024 will look at Savvy Social Security for couples. Wednesday, March 20th at 11 a.m. in the RIA Advisors Classroom. And yes, there'll be food. Which one of you should take Social Security first? Should you both claim benefits? What about survivor benefits? The Savvy Social Security for Couples Lunch and Learn. Think of it as a double date for your money you can't outlive. Register today at realinvestmentadvice.com. Realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So just talk a little bit about speculation today, a lot of kind of the speculative action that's going on in the markets in general. And, you know, one of those areas of the most speculation, of course, is coming into cryptocurrency. And again, there's nothing wrong with that at all. Again, these new ETFs are creating a lot of inflows. The BlackRock Bitcoin ETF is the fastest ETF ever to reach 10 billion in assets. So again, they've got to buy Bitcoin. So that's why Bitcoin has been soaring off to the moon as of late. Now eventually that asset flow will slow, right? People that everybody wanted to buy the ETF will buy the ETF, and those flows will start to slow down. In fact, we're kind of seeing some of that already. But one of the things that we talked about before and that didn't exist before is that these ETFs have another side to them that you need to be aware of that will increase volatility. So again, so when people pile money into Bitcoins, right, they've got the ETF providers have to buy the Bitcoin. So again, it's not surprising. You've had a huge surge of assets into these ETFs, and turn around, these spot ETFs are bought. Price of Bitcoin goes up, so forth and so on. Okay, so that's fine. Now, if the idea was that everybody was just going to hold these things, that's one thing, right? But now you've introduced an instrument that is easily tradable. I don't need a wallet. I don't need a crypto exchange. I don't need anything else. I can just buy and sell this ETF all day long. But more importantly, there's another side to even that. I can sell them short. So what this introduces is a potentially another layer of volatility to the price of Bitcoin in the cryptocurrency market. And it's interesting, there was a graph out this morning from CoinShares. And if you take a look at flows, so the weekly flows into Bitcoin, they were up 1,727,000,000. Month-to-date flows were down 117 million. Year-to-date flows were 7 billion. So again, not surprising just because of these ETFs. But note down the list where short Bitcoin is. which had flows of $22.2 billion. Now, again, this is a small number relative to the inflows right now, so it's no big deal. But watch, the thing to watch here is that now the ability to short ETFs adds another layer of volatility, because now not only do I have just my normal sellers of Bitcoin, right? So hey, Bitcoin's run up a bunch and it's starting to come down, so I'm going to sell some. Not only do I have that selling, I now have potentially people that don't even own Bitcoin shorting the ETFs. Now, this doesn't mean that anything else is what it is, but this is the way the whole market works, right? I can short stocks, I can short ETFs, I can do whatever. So there's nothing wrong or inherently vicious with any of this, but the thing you need to understand is that by adding on this, the invention of the Bitcoin ETFs were great, right? Gave people access to cryptocurrency without having to have wallets or exchanges or anything else. I can just go to my Fidelity account and I can buy an ETF, right? And it supposedly will track the price of Bitcoin over time. We'll see how well that works out. But so far, so good. But what investors typically don't understand is that once you have the ETF, you now have the ability to short those ETFs, which can create and enhance the volatility to the downside of these things. Don't get me wrong. I'm not saying that crypto's about to crash. Okay, and so if you're long, I'm long cryptocurrency. Okay, so it's fine. But I just want you to understand that there is an inherent risk that's been added to an already volatile asset. There's like I said, just recently, Bitcoin has done very well. Let me see if I can find this one other chart here real fast. There we go. Let me reduce this just a little bit in size, maybe, if my computer will cooperate with me, and it won't. Okay, let me get it real fast. Just do the best you can with that. So Bitcoin is now back to previously testing all-time highs. Okay. Again, this is a very volatile asset. You've got a lot of momentum. The momentum indicators are very elevated. The price is very elevated. So again, I'm not saying that cryptocurrency is about to crash. So don't go run off and say, well, Lance said Bitcoin's about to crash. I'm not saying that. What I am discussing with you is that these ETFs add an extra layer of volatility that we haven't had previously to an already volatile asset. And again, that chart's deceiving, right? Because it's on log scale. But that's 60,000 to 20,000 back to 60,000. So price volatility is extremely high. And that may be something you're not quite prepared for if you're buying these ETFs. You're thinking, oh, the ETFs are just going to, Bitcoin's going to go to the moon and these ETFs will go with it and it's all great. Just be careful. I'm not a big fan of Peter Schiff, but he made an interesting point this morning. These ETFs are really the tail that is wagging the Bitcoin dog. I think it's all about these ETFs. Of course, Bitcoin lives by these ETFs. It's going to die by the ETFs, and it's probably not going to be a very long life. Now, I don't necessarily agree with that point, but he is right that because of the magnitude of the size of these ETFs, and it's not just one, right? It's not just one ETF. It's not just BlackRock's ETF. It's ARK, it's Fidelity, it's Grayscale, it's all these other ETFs as well. I think there's like 10 or 11 of them now. That's creating a huge amount of flow into these ETFs, into an asset that has limited supply. So that's what drives the price up in the short term, but unfortunately, it also works in the opposite. So just be careful. Again, nothing wrong with this. If you want to add a little bit of Bitcoin ETF to your portfolio, etc., that's up to you. Just understand what your risk tolerance is. My point is to just lay out to you that there is likely going to be even more increased volatility in cryptocurrencies now than before because of these ETFs. And again, as always, Wall Street was happy to provide the product. There was a huge demand by people for an ETF around Bitcoin because they didn't want to get the wallet. They didn't want to do all the other, things you had to do to have, a crypto exchange, right? Just give me an ETF. I can buy it, put it in my Fidelity account. I can just trade it when I want it. Huge demand for that by retail investors. So Wall Street gave it to you. Just understand there's another side to that story. And that's all I'm trying to lay out to you this morning. Because, again, Bitcoins are pulling in funds at a record pace. And so, again, that's why, these things are going up dramatically. So, just take it for what it's worth. Jeff Bezos has now surpassed Elon Musk as the world's richest man. I'm not sure that even matters when you're talking about a few billion here or there. I mean, once you've got a billion, there was this video online the other day, and the guy said, "Would you slap your wife for $1 billion?" All I have to do is ask her, "Honey, can I slap you for $1 billion?" She's going to say, "Yeah." You can slap me twice for $1 billion. Don't ask stupid questions. But the point is, once you've got a couple $100 billion, I'm not sure you being the richest man or the second richest man, I'm not sure that really matters to any great degree at that point. You just have too much money. And I'm not one about that, right? Because I'm all for capitalism. I think, capitalism is the best economic system on the planet. Yes, it's got flaws, it's got chinks in it, but it's still the best ability to generate wealth over time is through capitalism. But even I have to admit that at some point it's a little egregious. And, I don't know there's nothing more to say about that. It's just you have to kind of scratch your head about, once there's a couple $100 billion, and again, nobody even fathomed this back in the, in the 1900 early, last century in the 1900s. Nobody even fathomed somebody having $1 billion, much less a couple of $100 billion. It's just a phenomenal amount of wealth.
What's another zero on the end?
Yeah. And, he's going to be the first trillionaire.
Yeah.
I mean, it's somebody that we don't know yet, but somebody's going to come along and invent something that replaces everything. I
Probably
guess.
One of your kids.
Nah. I'm just trying to get them out of college right now. I haven't even talked to my son hasn't even called me in like 4 weeks. I'm not even sure if he's still alive or not. So I've got to guess I should call him and see. Guess he's okay. He hasn't called and asked me for money, so he's either in jail or dead. I'm not sure which. Anyway.
Kids
wraps
these
up,
days.
Yeah. Wraps up the show for the day. All right. Get by the website, realinvestmentadvice.com. Please like this channel and subscribe if you like it because, again, we're trying to grow our base so that we can provide more stuff for you. So all your support is greatly appreciated. Get by the website. Our latest blog posts are out. realinvestmentadvice.com. Send your question, comments. Always happy to help you. Have a great day.